Welcome to the Deep Dive. We're your shortcut to really understanding what matters, cutting through all the noise. You know that feeling, right? Maybe it's tax time looming, or you're just trying to get your financial life sorted for something big. It can feel like there's just this mountain of documents staring back at you. Well, think of us as your guides for that climb today. Our deep dive is all about cracking the code on your annual financial organization. We're focusing on a really comprehensive checklist. It covers personal info, work stuff, housing, finances, basically everything. And it's more than just a list, really. It's like a roadmap to understanding what you need and, why.
Exactly. Our sources for this are snippets from a super detailed organizational checklist. It's incredibly thorough. We've sort of boiled it down to the essentials for you.
Right. And our mission here is pretty simple. We're going through this checklist together. We'll demystify the documents, point out some things you might not expect, and just bring clarity. The idea is for you to feel prepared, knowledgeable, not swamped by it all. Okay, let's dive in. It might seem like just an inventory list, but honestly, there are some key insights tucked away in here. The foundation, personal information, and income. So let's start right at the foundation, the personal details. The checklist kicks off with, the obvious stuff. Taxpayer SSN or ITN, date of birth, same for dependents. And your driver's license. Seems straightforward, but where do people sometimes trip up, even on these basics?
Yeah, it's you'd think it's simple. But what often gets overlooked is how one little mistake here, a typo in a birth date, maybe swapping 2 digits in an SSN can just cascade. These details are basically the keys. They unlock everything else. We've seen delays, mismatched records, even audits, all stemming from a tiny error on these fundamental pieces. So double checking isn't just about ticking a box. It's really a safeguard. Saves you headaches down the road.
Okay, good point. Foundational safeguard, I like that. Then the checklist jumps into income, and wow, this section is broad. Most of us think W-2, right? Your job pays you, but this list goes way beyond that. We're seeing unemployment, that's a 1099-G, miscellaneous income, like for rent maybe on a 1099 initially, pensions, annuities, that's a 1099-R, even Social Security or railroad retirement benefits, that's an RRB 2099 form.
Exactly. And if you sort of connect this to the bigger picture, it really shows how diverse income streams can be today. It's not just about the 9 to 5 anymore for a lot of people. You might have multiple sources. This checklist makes sure you don't miss anything. It even calls out things like income from partnerships, S-Corp, trusts, those Schedule K-1s. The key takeaway, really, is that the authorities, like the IRS, they expect all income reported. It doesn't matter where it came from or how you got it.
And then there are these ones that I think surprise people, like jury duty pay, alimony received, gambling winnings, lottery winnings, prizes, awards, scholarships too, even state and local tax refunds, which can also be on a 1099-G sometimes. Why track every single one of these? Is it really that critical if it's small?
Well, yeah, they often fly under the radar. They don't feel like a paycheck, right?
Yeah.
And sometimes you won't even get a tax form if the amount is below a certain threshold, like maybe you won $500 in a raffle. No form, but it's still income. The risk of not tracking it, unreported income. That can mean you owe more tax later, plus penalties, interest. It adds up.
Yeah.
So yeah, even the small stuff, the smart move is just to keep a record of every inflow. Then you have the details if you need them. To your home, your finances, homeowner rental data, and financial assets and liabilities.
Okay, let's shift gears a bit. Let's talk about, for many people, their biggest asset, their home, and also the broader financial landscape, investments and such. What's this part of the checklist telling us about managing that side of things?
This section really raises an important question. How do these big-ticket items, your house, your investments, impact your annual financial reporting? And importantly, are there tax advantages or specific tracking needs here? For housing, the checklist gets pretty specific. It asks for your mortgage interest statement, the 1098, details if you sold your home or any other real estate that's often a 1099-S. And it even mentions things like second mortgage interest paid, rent you paid during the year, and moving expenses.
Interesting. It gets that granular, like second mortgage interest or moving expenses. Why is that level of detail needed? What's the strategy behind tracking that beyond just reporting?
Well, the granularity is all about potentially finding deductions or making sure you calculate things like capital gains correctly. Take second mortgage interest. Sometimes it's deductible, sometimes not. Depends on how you use the loan. The rules can be different from your primary mortgage. And moving expenses, you're right, they're more limited now, but for some, like military families moving on orders, it can still be a significant deduction. So having the exact documents, like that 1098 for interest, means you don't accidentally leave money on the table. Or, crucially, miscalculate something big like a home sale. You might get an exclusion on gains up to a point, but if you go over, you need precise numbers.
Okay, that makes sense. Precision matters there. Then moving from real estate to other financial stuff, assets and liabilities. For assets, it lists the usual suspects. Interest income on a 1099 INT or 1099 OID, dividends on a 1099 DIV, proceeds from stock sales on a 1099 DOIB, retirement plan payouts on a 1099-R. But then under liabilities, it's different. It asks about penalties for early CD withdrawal and specifically stock and bond transaction information. That feels different than just listing an income form. Why the need for detailed transaction info here?
That's a really sharp observation. There's a crucial difference. Those 1099s you mentioned, INT, OID, DIV, B, they're mostly reporting money you received or proceeds from sales. But the liability side, or things like transaction details, point to specific events. Maybe you paid a penalty that could actually be deductible. Or for stock sales, the 1099-B gives you the proceeds. But the real challenge, the place people get tripped up, is knowing their cost basis. What did you originally pay for those shares? Without that cost basis, you can't figure out your actual gain or loss. You could easily end up overpaying your taxes. So that transaction information, especially the cost basis, is absolutely vital. It determines your gain, your loss, even impacts rules about selling and rebuying shares quickly, the wash sale rules. 3, the outgoing, taxes paid and expenses.
All right, let's pivot to the money going out. Taxes you've paid and all sorts of expenses. Sometimes, it feels like the real leverage isn't just what you earn, but carefully tracking what you spent.
Absolutely. And what's often underestimated here is just how many different types of expenses might be relevant. It's a really broad scope from big categories down to very specific things.
Yeah.
And documentation is key. Look at taxes paid. The checklist wants federal, state, local estimated taxes you paid during the year. And it specifically says estimated tax vouchers, canceled checks, and personal payment records. That's quite specific. It also includes local and state personal property tax, real estate tax, business taxes. Again, emphasizing payment records.
Yeah, that phrase canceled checks and personal payment records jumps out. In our digital age, is that still necessary? Isn't an online confirmation enough proof?
That's a great question. It really comes down to having undeniable proof of payment. While digital records are definitely more common and usually accepted, a canceled check image or a very clear official payment confirmation directly from the tax agency is still sort of the gold standard. Why? Because it proves the money left your account and went specifically to them. Think about estimated taxes paid quarterly. If there's ever a question, that canceled check or official confirmation is your receipt. Without it, you could face underpayment penalties even if you did send the money. It's basically about having audit-proof records.
Audit proofing. Okay, that's a clear incentive. Then the list moves into this wide range of other expenses that could really make a difference. Things like charitable gifts, both cash and non-cash items, unreimbursed costs if you do volunteer work, investment-related expenses, medical savings accounts, and then this huge breakdown for medical. Prescriptions, insurance premiums, supplies, eye exams, glasses, contacts, copays, even mileage for medical transport and just other, wow. Plus adoption costs, alimony paid, and fees for tax prep. That is a lot to keep track of.
It is. And the real insight here is that many of these, even if they seem small one by one, can really add up. Take that medical list. It shows how many different healthcare costs might be deductible if your total medical spending crosses a certain percentage of your income. A common mistake is people only remember the big hospital bill, but forget all the little copays or the miles driven to appointments throughout the year, or those volunteer expenses. It's not your time that's deductible, but things you paid for out of pocket, like gas or supplies you bought for the charity work. For every single one of these, the documentation, receipts, logs, statements, it's absolutely essential. Without proof, you just can't claim it, even if it was a legitimate expense. 4. Life's specifics. Daycare, education, miscellaneous, and business employee expenses.
Okay, now we're getting into the really specific stuff. Categories that might apply depending on your life situation and your job. For a lot of people listening, these sections could hold some real keys.
Yeah, if we kind of zoom out again, these parts of the checklist often point to tax credits or deductions that are very targeted. They match up with certain life stages or career paths. Take daycare. The checklist is explicit. You need the total childcare cost, the provider's name and address, and this is critical, their social security number or employer identification number, EIN.
That provider ID, the SSN or EIN, that's a big one for daycare, right? And for education, we see job-related courses, tuition fees reported on a 1098-T, student loan interest on a 1098-E, even mileage driven for education. Why are these specific details, like the ID numbers and form numbers, so non-negotiable?
They're non-negotiable, primarily because the IRS uses them to verify everything. They cross-reference. For daycare, having the provider's ID confirms who received the money. It helps prevent fraud and ensures everybody's reporting matches up. For education, those forms, the 1098-T from the school, the 1098-E from the loan provider, are official tax documents. They contain the exact numbers, like qualified tuition paid or interest amount, that you absolutely need to claim education credits or deductions, which can be quite valuable. Trying to claim those without the forms or the specific info they contain, it's very difficult to prove eligibility.
Okay, verification is the name of the game there. The checklist also has this miscellaneous documents section. Feels like a catch-all, but seems important. It lists prior year tax returns as the past three if you have them, along with old W-2s and 1099s. Also asks about contributions to IRAs, KOGHs, that's for self-employed folks, right, and other retirement plans. It specifies noting if it's for yourself or employees if you run business.
That's right. KOGH is specifically for self-employed retirement savings.
And then it mentions records for casualty or theft losses, and records for any other possibly deductible expenses or any other income from selling property. That's a lot of other...
It really is the catch-all, isn't it?
Yeah.
And it kind of highlights a core principle, if you're not sure, document it anyway. Those prior year returns. Invaluable. Not just for reference, but sometimes deductions or credits carry over from one year to the next. Having a history helps spot those. And the other expenditures or other revenue bit, it just stresses you need good records for anything unusual, anything outside your normal routine, like a casualty loss, say storm damage. You need proof you own the thing, proof the storm happened, proof the value lost. You have to build a solid case for anything you claim that's outside the norm.
Build a case. Got it. And finally, this brings us to business and employee expenses. And this list is extensive. Covers business income, 1099 MISC or your own records, partnership income, K-1s, farm expenses, then employment taxes, retirement contributions, and then this huge list. Business use of car loans, leases, repairs expenses, entertainment, meals, job hunting costs, lodging, office and home, professional dues, publications, research, safety gear, supplies, telephone, tools, travel, union dues, uniforms and cleaning, vocational supplies. Phew, it's almost overwhelming.
It's quite a list. And the key phrase you see repeated or implied from many of these is, if for business use. That's the absolute dividing line for whether something might be deductible. This section really drives home why meticulous record keeping is just non-negotiable if you run a business, or even if you're an employee with significant expenses your employer doesn't reimburse. Think about entertainment and meals. There are specific rules and limits, office and home, strict requirements about exclusive business use. So this raises a really practical question for you. How do you effectively separate personal spending from business spending? You need to do that to maximize your legitimate deductions, but also, importantly, avoid raising red flags with the IRS. Often, the best practice is having totally separate bank accounts and credit cards for business, and keeping detailed contemporaneous logs, meaning you write it down when it happens, for things like mileage, or who you had a business meal with and why. Outro.
So after all that, what does this really mean for you? Well, this deep dive wasn't just about running through a checklist. Hopefully you now have a more strategic view. You're armed with specific knowledge about which financial documents really count, why they count, and some of the hidden details in organizing all your info. It truly is a shortcut to being well-informed strategically.
Yeah, and what's really powerful, I think, is that by breaking down this comprehensive checklist, you gain more than just clarity. You actually gain a sense of control, agency over your own financial information.
Yeah.
It helps turn what can feel like a really daunting annual chore into a more structured process, one that you understand and can manage. You're not just gathering paper, you're actually building a clear, verifiable story of your financial year.
Exactly. So here's a final thought to leave you with. Think about which specific item on this detailed checklist, maybe one you haven't paid much attention to before, might actually hold the most surprising financial impact for your unique situation. And then, building on that, what's one single proactive record-keeping habit you could start today that would make the biggest difference in your financial clarity moving